Since 2005, FastSpring has operated as the default checkout engine for thousands of scaling software companies across the globe. If you are an Indian founder setting up global billing, you likely saw their 5.9% baseline rate and baked it into your margins. But when that first payout hits your bank account, the math often fails to add up because the real cost is significantly higher. You are suddenly faced with a massive operational choice. You can surrender a huge chunk of your revenue in exchange for automated global tax compliance, or you can use direct payment infrastructure and keep those margins for yourself. If you run a bootstrapped or mid-market Indian software business, or sell digital products globally, and process under $100,000 in monthly revenue, this decision dictates your runway. Defaulting to a US-centric merchant of record like FastSpring, without auditing your real tax exposure, creates a heavy, unnecessary drag on your early-stage margins. To see why the reality doesn't match the expectation, we have to look past the top-line percentage and break down the specific mechanics of their pricing model. FastSpring's actual baseline starts at 5.9%, plus a fixed 95 cents per transaction. This side-by-side bar chart shows the impact. That 95 cents applies to every single monthly charge, not just the initial sign-up. Let's run the math on a standard $20 a month software subscription. You pay the 5.9%, which is $1.18, plus that fixed 95 cents. That totals $2.13 every month. Your actual effective fee just crossed 10.6%. Then there is a secondary structural cost. When you issue a refund to a customer, FastSpring retains its original transaction fee. You eat the refund cost out of pocket, plus the fee you already paid. This specific fee structure penalizes low-ticket SaaS products. Every billing cycle, those fixed fees compound, steadily eating into your recurring revenue. And that is just the platform commission. The next layer of friction hits when you actually try to move that money into your Indian bank account. This waterfall chart illustrates the real settlement process. FastSpring does not settle directly in Indian rupees. They pay out in US dollars via wire transfer. Let's track a typical $5,000 transaction. First, the platform strips away its commission. Then, you get hit with a standard wire transfer fee, usually between $15 and $30. Finally, your Indian receiving bank takes its cut. They apply a 1 to 2% foreign exchange markup to convert those dollars into rupees. This brings us to the alternative model, direct payment infrastructure. Instead of a merchant of record, you use a system like Playto Pay. Playto Pay uses completely different settlement mechanics. They charge a flat 4% on cards, and they settle directly in INR to your Indian bank daily, with zero foreign exchange markup. By controlling the currency conversion and the settlement layer yourself, you eliminate the middleman fees and can recover up to a third of your lost profit margins. The primary defense for paying the merchant of record premium is compliance. The pitch is simple. You pay the high fees, and they handle the tax. To be fair, they do certain things very well. If you have crossed economic nexus thresholds in multiple US states, or have significant EU VAT exposure, FastSpring registers, collects, and remits those taxes for you. But here is what they explicitly do not handle for Indian entities. They do not manage your local GST filing on the export of services, and they do not handle Indian FEMA compliance. Regardless of which global platform you use, you still have to retain and pay a local chartered accountant to handle your Indian books. Direct infrastructure platforms approach this differently. Systems like Playto Pay automatically generate FIRA documents, foreign inward remittance advice, on every single international transaction. Your CA simply takes these automated FIRA documents and uses them to cleanly file your required GST on exports. If your business is doing under $100,000 a month, paying a 10% more premium for US and EU tax features you haven't mathematically triggered yet is an irrational expense. Let's look at this comparison matrix to stack the legacy merchant of record model directly against modernized direct infrastructure. First, look at the effective fee comparison. You are comparing roughly 9 to 11% on FastSpring against a flat 4% on Playto Pay. Next, payout cycles. Legacy platforms hold your funds for 7 to 14 days. Direct infrastructure settles daily. And crucially for Indian founders, direct INR settlement and automated FIRA generation. FastSpring fails on both counts, while Playto Pay handles them automatically. If you are at a scale where you genuinely need MOR coverage, but you want more modern developer tools than FastSpring, platforms like Paddle or Dodo Payments are solid intermediate options. The right payment stack depends on which financial mechanics map to your company's current scale. Let's translate these abstract percentages into a concrete, real-world financial scenario to show exactly what is at stake. This area chart plots an Indian SaaS company processing $50,000 in monthly international revenue. On FastSpring, factoring effective MRR rates and Forex hits, annual payment costs drain roughly $60,000 to $66,000. On Playto Pay, that annual cost is capped at $24,000. That leaves you with $36,000 to $42,000 in pure cash savings every single year. You can use that to hire a senior engineer in India or secure 18 months of office space. Optimizing your payment stack away from legacy merchants of records functions as an instant, non-dilutive funding round for the business. To definitively choose your processor, this decision tree outlines the framework based on your profile. If you exceed $1 million in annual revenue, with complex U.S. Nexus and enterprise B2B needs, FastSpring is the correct choice. At that scale, the high fees are a justifiable insurance policy for multi-jurisdiction audit defense. If you operate below that enterprise scale but genuinely desire the hands-off tax convenience of a merchant of record, choose modern alternatives like Paddle or Dodo Payments. And finally, if you are an Indian software business doing under $100,000 a month, needing clean cash flow, direct INR settlement, and basic FIRA compliance, direct infrastructure like Playto Pay is the optimal choice. If you are worried about the operational headache of switching, you can migrate smoothly by running platforms in parallel. You keep your existing subscribers billing on the legacy system and route all new signups through your new infrastructure. Do not buy an expensive global compliance insurance policy for a scale you haven't reached yet. Choose the infrastructure that maximizes your present reality.